Welcome to another insightful video from Dr. Chris's Key to the Manager's Mindset on Individual Development and Productivity Improvement. In today's session, we are diving deep into the world of finance, specifically the stock market. This video is your beginner's guide to understanding how the stock market works and how you can participate in it to grow your wealth. Whether you're just starting your financial journey or looking to expand your investment knowledge, understanding the stock market is crucial for achieving your financial goals. Imagine a bustling marketplace, but instead of fruits and vegetables, you're trading pieces of ownership in companies. That's essentially what the stock market is, a platform where buyers and sellers come together to trade these ownership units, called stocks. Think of companies like Apple, Tesla, or Amazon. By buying their stock, you're essentially buying a small piece of these companies. These transactions take place on stock exchanges, with the New York Stock Exchange, NYSE, and NASDAQ being the most prominent ones in the US. They act as regulated marketplaces, ensuring fair and orderly trading. Now you might be wondering why even bother with the stock market. Well, the answer is simple: potential for growth. Historically, the stock market has delivered higher returns compared to traditional savings accounts or bonds. While it's not a get-rich-quick scheme and involves risks, investing in stocks gives your money a chance to outpace inflation and grow significantly over the long term. Moreover, investing in the stock market allows you to diversify your portfolio. Let's explore the different avenues you can invest in within the stock market. Stocks, as we discussed, represent ownership in individual companies. Then we have bonds, which are like loans you give to governments or corporations in exchange for interest payments. If you're looking for a ready-made basket of stocks or bonds, mutual funds and exchange-traded funds, ETFs, are a great option. They pool money from multiple investors to invest in a diversified portfolio of assets. The process of buying and selling stocks is simpler than you might think. You'll need a brokerage account, which acts as your gateway to the stock market. Once you've funded your account, you can easily place orders to buy or sell stocks through your broker's online platform. Stock prices fluctuate throughout the day based on supply and demand. When you see a stock quoted at a certain price, that's simply the price at which the last transaction took place. To track the overall performance of the market, we use stock indices like the S&P 500 or the Dow Jones Industrial Average, which represent a basket of prominent company stocks. Before you even think about buying your first stock, it's crucial to establish clear financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Defining your goals will help determine your investment timeline and risk tolerance. Remember, the stock market can be volatile in the short term, but over the long term, it has generally trended upwards. Now that you have your goals in mind, it's time to create a budget that accommodates your investment plans. Start by analyzing your income and expenses. Identify areas where you can potentially reduce spending and direct those funds towards investing. A helpful rule of thumb is the 50-30-20 budget. Allocate 50% of your income to needs, 30% to wants, and 20% to savings and investments. Remember, consistency is key when it comes to investing. Even small, regular contributions can add up significantly over time thanks to the power of compounding. To enter the stock market, you'll need to open a brokerage account. There are numerous brokerage firms out there, each offering different features, fees, and investment options. Some popular options include online brokerages like Robinhood, TD Ameritrade, and Fidelity. When choosing a brokerage account, consider factors like trading fees, account minimums, research and educational resources, and the availability of customer support. Take your time, compare different options, and choose a brokerage that aligns with your investment needs and preferences. Now let's dive into the exciting world of stock analysis. One approach is fundamental analysis, which involves evaluating a company's financial health and growth prospects. Start by examining the company's financial statements, including their income statement, balance sheet, and cash flow statement. These documents provide valuable insights into the company's revenue, expenses, assets, and liabilities. Look for key financial metrics like earnings per share, EPS, price-to-earnings ratio, PE, and return on equity, ROE, to assess the company's profitability, valuation, and management efficiency. Another approach to stock analysis is technical analysis, which focuses on studying historical price charts and trading patterns to identify potential future price movements. Technical analysts use various tools and indicators such as moving averages, support and resistance levels, and MACD to interpret price trends and make trading decisions. While fundamental analysis helps you understand the intrinsic value of a company, technical analysis can provide insights into market sentiment and potential trading opportunities. The stock market is constantly evolving, influenced by a myriad of factors such as economic data, geopolitical events, and industry trends. Staying informed about market news and events is crucial for making well-informed investment decisions. Reliable sources for financial information include reputable financial news websites like Bloomberg, Wall Street Journal, and Financial Times. Additionally, subscribing to investment newsletters or podcasts can provide valuable insights and analysis from industry experts. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. Diversifying your investment portfolio involves spreading your capital across different asset classes, sectors, and geographies. By diversifying, you reduce the impact of any single investment on your overall portfolio. For example, instead of investing solely in technology stocks, consider diversifying into healthcare, consumer goods, or international markets. There are numerous investment strategies you can employ, each with its own level of risk and potential return. A popular long-term strategy is buy and hold, where you purchase quality stocks and hold them for an extended period, riding out market fluctuations. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps mitigate the risk of investing a lump sum at a market peak. Dividend investing focuses on investing in companies that pay regular dividends, providing a stream of passive income. Investing in the stock market always involves some level of risk. It's essential to have risk management strategies in place to protect your capital. One common strategy is setting stop-loss orders, which automatically sell a stock when it reaches a certain price, limiting potential losses. Another approach is diversifying your portfolio, as we discussed earlier. Remember, never invest more than you can afford to lose, and always be prepared for market fluctuations. Your investment portfolio is not something you set and forget. It's crucial to review your portfolio regularly, at least annually, to ensure it's still aligned with your financial goals and risk tolerance. During your portfolio review, assess the performance of your investments, rebalance your asset allocation if needed, and make adjustments based on your current financial situation and market conditions. Remember, your financial goals and risk tolerance may change over time, so it's essential to keep your portfolio aligned with your evolving needs. One of the biggest challenges in investing is managing your emotions. It's easy to get caught up in market hype or panic during periods of volatility. However, making emotional decisions can be detrimental to your long-term investment success. Stick to your investment plan, avoid trying to time the market, and stay focused on your long-term goals. Remember, the stock market is a marathon, not a sprint. Many investors fall into the trap of trying to time the market, buying when they think the market is low and selling when they anticipate a downturn. However, consistently timing the market is extremely difficult, even for seasoned professionals. Instead of trying to predict short-term market movements, focus on investing for the long term. Remember, time in the market is more important than timing the market. Overtrading or trading too frequently can be detrimental to your portfolio performance. Each trade incurs transaction costs, such as brokerage fees and commissions, which can eat into your returns. Moreover, frequent trading can lead to impulsive decisions driven by emotions rather than sound investment principles. Remember, patience is a virtue in investing. Focus on making well-researched long-term investments rather than chasing short-term gains. While brokerage fees may seem small on an individual trade basis, they can add up significantly over time, especially if you're trading frequently. Be mindful of fees associated with your brokerage account, including trading commissions, account maintenance fees, and inactivity fees. Additionally, be aware of the tax implications of your investments. Capital gains or profits from selling investments are subject to capital gains taxes. Consult with a tax advisor to understand how your investments impact your tax liability. The world of investing is vast and constantly evolving. Continuously educating yourself is crucial for staying ahead of the curve and making informed investment decisions. Fortunately, there are numerous educational resources available to help you expand your investment knowledge. Consider reading classic investment books like The Intelligent Investor by Benjamin Graham or One Up on Wall Street by Peter Lynch. Online courses and tutorials offered by reputable institutions like Khan Academy, Coursera, and Udemy can provide structured learning experiences. Technology has revolutionized the way we invest, providing us with powerful tools to analyze, manage, and track our investments. Stock screeners allow you to filter stocks based on specific criteria, such as market capitalization, industry, or financial ratios. Portfolio trackers help you monitor the performance of your investments, track your asset allocation, and identify areas for improvement. Financial calculators can assist you with various calculations, such as compound interest, retirement planning, and mortgage amortization. We've covered a lot of ground in this beginner's guide to the stock market. Remember, the stock market is a powerful tool for building wealth over the long term. By understanding the basics of investing, setting clear financial goals, and following a disciplined approach, you can increase your chances of investment success. Start by educating yourself, choosing a suitable brokerage account, and gradually building your investment portfolio. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more insightful content on individual development and productivity improvement. I'm passionate about helping you achieve your full potential, both personally and financially. Leave a comment below and let me know what other financial topics you'd like me to cover in future videos. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by staying informed, staying disciplined, and continuously learning, you can navigate the stock market with confidence. I wish you all the best in your investment journey. In this video, we've demystified the stock market and equipped you with the knowledge to start your investment journey. Remember to start with clear financial goals, create a budget, and choose a brokerage account that suits your needs. Continuous learning is key, so take advantage of the educational resources and tools available.